Okay, so what would actually happen to the markets if they don't manage to raise the debt limit in time? All right, so let's talk about it. Okay, so our government leaders, they're on the clock, okay? They've got about 3 weeks from today. So today is what? May 12th. So, so they've got what? About 3 weeks probably to manage to raise that debt limit. And if they don't, I want to talk to you about what the consequences are. Now, listen, our government has a history of this, right? Going right up to the edge. And usually what happens when they get to the situation where they can't get they pass what they call a continuing resolution. Maybe it's a way to buy them some more time. And that could very well be what happens here. Now, there have been a lot of financial advisors out there these days on YouTube and on the talking head shows saying that this time could be different. And they do have a point there. This time around, things are a little bit different. Now, we have an administration who they do not want to negotiate at all about the spending package, which actually puts them at odds with the Federal Reserve, right? So at a time when the Federal Reserve is trying to fight inflation by raising rates, the administration is spending more money, which causes inflation, right? So Janet Yellen is either ripping her hair out, saying, "What the hell are you doing to me?" Or she's saying, "This is fine by me," because it fits her plan, right? That's a whole different YouTube video. We've talked about that issue before. But Janet Yellen did also say that the idea that the U.S. government would default on their bond payments and their loan payments is unthinkable. Well, yeah, it is unthinkable. In the entire history of the United States, we've never defaulted on our bond payments. We never have. If that were to happen, boy, the prestige of America would plummet even more than it already has. It would be disastrous in our markets and to global markets. Now, one of the things that is different right now is the fact that this time around, we have a global de-dollarization effort going on. We have countries like Saudi Arabia. The Saudi Arabian Sovereign Wealth Fund announced publicly that they're actually shorting our markets. So they're betting on our markets going down. So they are actively trying to take us down. A lot of governments are getting together to take down the US dollar. And so this is a relatively new phenomenon where there's an active global effort to take down the US dollar. So there are a few things that are different this time around. I mean, so will they manage to raise the debt limit this time around? Well, if I had to guess, my guess is yes, they will figure something out at the very last minute. Now, usually it involves the Republicans caving because they have a history of that. That's one of the reasons why the Democrats are sticking to their guns is because they know that the Republicans don't have that much of a spine. The Republicans have a history of giving in at the last minute. Now, listen, I am a conservative and a traditionalist first, and I'm a Republican, a very distant second. I'm more of a libertarian, right? But other two parties, I'm more aligned with the Republicans in theory, in philosophy. But the truth is, I have no use for a lot of Republicans too. So I'm not here to carry water for the Republicans. I have no use for a lot of those guys as well. But my primary message in this video, in this presentation, is to kind of demonstrate to you the possible consequences. I want to show you some important levels in the markets for you to be aware of. And I want you to understand the possible consequences, not just of this debt limit debate, but any number of financial issues that could cause the markets to tank or to go up dramatically. So I want to show you the important levels in the markets for you to be aware of. Now, one of the reasons why these levels are important is because I'm not the only one watching these levels. Not only that, but these levels, I promise you, they're plugged into the computer program, the algos, right? So when these levels are taken out, the algos will start kicking in, and then you're going to see computerized selling or computerized buying if levels are taken out on the upside. That's why you need to know where the important levels are and then come up with a plan. Maybe you say, all right, well, if that level is taken out, I'll do this. If that level is taken out, I'll do that. You should come up with your own plan. Because I don't want you to be looking at your 401k a year from now and saying, oh boy, if only I had. I want you to be forearmed, okay? Now, this isn't a I told you so videos where I can, look, I have plenty of those where I predicted things in the past, showing you the charts, and I could point back and say, look, I told you so, I told you so. This isn't about me. This is about giving you some tools and some ammunition, some knowledge that can benefit you. So I'm going to show you a few charts. And what I'm going to do is, okay, so I'm going to use the Dow Jones Industrial Average. So I'm going to use that index to kind of give you the levels. Some people use the S&P 500, but they're all the same, right? It's all about the message. What is the market telling me? And what I'm going to do, I'm going to start with a short-term chart, and then we're going to look progressively at longer-term charts to show you the important levels you need to know about. Now, I hope you'll forgive me. I got a little lazy here because I'm running out of time. I'm just going to show you these charts inside of my Canva. Okay, that way I can scroll through it easily. All right, so let's take a look at some important levels in the markets. So this chart might look a little bit different by the time you see it, but you get the idea. So the date today for the recording is May 12th, 2023. And this is the 1 month chart. Let's start with the 1 month. Let's start with a close-up look. This is the important resistance level here, that 33,800 level. That's the first challenge for the market to take out if it wants to move higher. But for the market to have a meaningful chance of moving higher, it really needs to take out this green line up here. Green doesn't show up really well on the chart, so I hope you can see it. That comes in at around 34,300. Really, if the market is going to have a meaningful chance at a significant rally, that's its first big challenge. It's got a minor challenge here at 33,008, but the real challenge, it's got to get above that 34.2 if it has any real chance of going higher in a significant way. And then the near-term support level, the important near-term level, is just under 33,000. We'll call it 32,950. It's just under that 33,000 level. So these are the three important levels at the moment. Now, if we pull back a little bit and we look at the 3 month chart, you get a better idea of consequences. Now you can see why that green level, that resistance level, which we just talked about, is so important. It's got a double top there, and it just came off of a rally, and this rally here did not manage to take out that previous rally. So that tells me this market is losing steam on this rally. If the market goes below this red line around, that 32,009 area, if it takes out 32,009, then you're gonna see programs start to kick in. The next support level is down here around that 31,500 level. This is the next support level. So if this level is taken up, the next support is down here. This would be my next target. Let's pull back a little bit more. Now, the longer the time frame is of the chart you're looking at, the more significant the levels are. Right, that's why I'm progressively showing you longer term charts. All right, let's go back. Okay, now we're at the 1 year chart, and we are starting to see how significant these levels are becoming. All right, so if this level down here is taken out, so we have minor support here at 32,009, right? If that is taken out, the next target level would be 31,008, and that becomes support. And this is where I would expect the market to find some support. This is where it should stop going down a little bit. Now, it might put in a little bit of a rally. That's what happens when important support levels are gotten to. It's defended by the bulls. But if that level at some point is taken out, the next level is 28,008. You can see this is the next important support level. All right, so let's scroll out a little bit more. This is the 4 year chart. If you look back here, you see this QE sugar high. This is a 2 year sugar high rally caused by a very aggressive QE program, basically free money. This is where the Federal Reserve had interest rates at 0%, and it was free money. And the market likes free money, but there are consequences to that, right? Sure enough, the market had a nice big rally there, and you can see just before that rally, we had that nasty sell-off, and that's why they came up with their free money policy. That was their way of saving the market, which the Federal Reserve is not supposed to be doing. But that's what they do. These guys are political animals in a large degree. And Wall Street they were raising hell, and they caved. So they implemented QE policy, created a sugar high, but then it ran out of steam. The market put in the double top right here. And since then, the market has not been able to get anything going. Since that big rally and since this double top, we have been largely in a sideways move in the market, just a real sloppy trading range. That's why this is a trader's market. There's a lot of volatility in here. There's a lot of room for active traders to make money. But for an investor, if you got your money in the 401k, you're not taking advantage of these big swings. So you've gone nowhere. Your 401ks, your investment money has done nothing. So this is not an investor's market. This is a trader's market. But let's get back to the support levels. All right. So if this support level is taken out, remember, we just looked at it up here, right? If that level is taken out, the next target is 19,005. It's way down here at the beginning of this QE sugar high rally. That's where the next objective is. So am I predicting that these levels are going to be taken out? Not necessarily. Look, first things first. First, we have to watch the levels be taken out. Now, why those levels are being taken out is almost irrelevant, because this is the way Wall Street thinks, right? It almost doesn't matter what the reasons are for the market selling off or breaking out. They're looking at levels. Remember, as we talked about before, fundamentals don't mean anything. Why stocks, why bonds, why cryptos are going up is irrelevant. Remember, you're not trading stocks in the case of a stock market. You're not trading cryptos. You're not trading bonds. You're trading people. And people are emotional beings. That's why the market will never be rational. But we can look at human nature. We can look at emotion in the charts. The charts are just, pictograms. They're just pictures of human emotion. They're a way of visualizing human emotion. You can see where the fear is. You can see where the greed is. You can see where the complacency is. It's all built into the charts if you know how to read the charts. So if I were you, I would identify the critical levels in the markets, both on the upside and the downside, and you might want to consider making decisions accordingly. For example, if that critical support level is taken out, you might want to consider, going to cash or becoming more conservative, or at least maybe putting a portion to cash, whatever. The money you don't lose is just as important as the money that you make, right? As Rob Bruss would put it in military terms, discretion is the better part of valor. Now, there are a lot of people out there with agendas. So when the market starts to approach an important support level, usually has some kind of a rally before it rolls over and goes down. These things don't happen in a day. Okay, I mean, sometimes you get massive moves in a day, and if there's some kind of an event like an EMP attack or China attacks, Taiwan, there are some events that could have a panic selling event in the market, but you can't predict those things, right? They happen. But I want you to know about these important levels so that you can come up with a plan. It's all about protecting your money, protecting your wealth, right? And there are also ways to take advantage of the market going down. That's a trader's mentality, but we won't get into that here. It's a whole different video. But for whatever it's worth, my opinion is the market has much more downside risk than upside potential. For the market to take out that important resistance area, let's take a quick look back. Okay, for the market to take out this $35,000 level and stay above it, okay, something pretty important has to happen. There has to be some kind of a catalyst. Without a significant catalyst, I just don't see it going above there. But if it did, it can't just stick its head above there. It's got to get above there and then stay above there for a while. So what potential catalyst could drive the market up? Well, what if the Federal Reserve decided to pivot, okay, and stop raising rates? And that could happen, right? If there's a dramatic event that drives the market down, the Fed could come in and save the day, like they did during that 2-year sugar high rally, right? They could come in, they could pivot, and they could start lowering rates. It could happen. Now, of course, that's going to send us into hyperinflation, but Wall Street would like it. I mean, remember, Wall Street's interests do not necessarily align with your interests, all right? Okay, so I hope you find some useful nuggets in there. Ed Anderson, live from Minnesota, signing out.
Copy that.